In this lesson, we'll introduce you to the reward to risk ratio and show you why it's key to your success as a trader. The reward to risk ratio is simply the amount of profit you may earn on a trade in comparison to what you could lose on a trade. The goal for any trade you take per this strategy is a reward to risk ratio of at least 3 to 1. That means the reward that the trade offers is 3 times the increment risk size. This is important because, for example, say a trader were to make 4 trades and each trade they risk $1 per trade with a potential profit of $3 per trade. This would satisfy the 3 to 1 reward to risk ratio. Looking at the example here, the first trade is a loss. The second trade is another loss, stopping out at $1, which is our risk size per trade. We are now at 0 for 2 for our win rate. The third trade is another losing trade, and now we are at 0 for 3. The fourth trade, however, hits the target and results in a $3 profit. The final numbers show that the trader was only successful 25% of the time, but still managed to break even, meaning in the end, they didn't lose any money. Now, what's important to understand from that example is that the loss side is not and should never be flexible. This is why we use a stop loss, so that losing trades never pass that point. In this case, $1 per trade. On the target side, however, we may be going for a 3 to 1, perhaps 5 to 1, or it could turn into something greater. We target trades that provide a minimum of 3 to 1 reward to risk ratio, although 5 to 1 is preferred. At the top, you see a visual example of the importance of the reward to risk ratio. If you look at the top, which one of these two types of win-loss ratio equations do you think makes a better trader? The top one combines 70% wins with a low reward to risk ratio. In this case, you're winning more, but the reward for winning the trade is less. If we go back to our previous example where our reward to risk was 3 to 1 and assume that our reward to risk is now 2 to 1, losing 3 trades and winning 1 trade would put us at a loss. In that case, we would need to win at least 50% of our trades to break even. Looking at the equation on the bottom, we have a mix of 30% wins. Remember, that's losing 70% of the time, but with a high reward to risk ratio. Surprisingly, the trader with less wins and a higher reward to risk ratio will ultimately be more successful in the long run. Both combinations target trades that provide a minimum of a 3 to 1 ratio, but the bottom prefers a reward to risk ratio of 5 to 1 or greater. If you plan on intraday trading, which simply means you're trading within the day or regular business hours, you should consider reaching your objective or profit target within your daily trading session. Here at the center of the screen, we see a price chart for XLE, which is an ETF for energy. Now, don't worry about not being able to see it very well. Just understand that it illustrates a demand zone from $61.50 to $61.41. The zone is mapped out when we see prices come down and touch the zone several times. At the top, we can see a supply zone, which is also mapped out and also highlighted in yellow, and it is also based on past levels. Now, in a perfect world, we love a profit potential of at least 20 to 1. But since the setup is a potential day trade, there is a low likelihood of reaching that full reward to risk potential. Since we want a higher probability of success, we set a predefined target of 3 to 1 or greater. On this chart, we have targets set for 2 to 1, 3 to 1, 5 to 1, and 8 to 1. If you look at the chart on the right hand side, you can see the black arrows representing those outcomes. Each target has a different probability of success, yet giving us a better idea of what we're trying to achieve. As you progress through the course, you will apply the reward to risk ratio on every trade you take and set multiple targets. Keep in mind, 3-to-1 is the minimum, 5-to-1 or greater is preferred. And again, this will assist you with remaining profitable in the event you lose more trades than you win. Now you have a basic understanding of reward to risk ratios and why it's so important to your success as a trader. Before you move on, review where you placed your pre-planned entry, stop, and targets in previous lessons and determine if your setups achieved the minimum 3-to-1 reward to risk ratio. Also, as an experiment in probability, take a coin, such as a quarter, and flip it. For every heads, you win $5, and for every tails, you lose $1. Flip the coin in multiples of 10. Do this on multiple occasions and track your progress to gain a better understanding of trade probability and why a reward risk ratio of 5-to-1 is preferred. Also, visit the link within the Google Drive account below and begin to familiarize yourself with the engineered risk strategy. Using the engineered risk strategy, practice going through the calculations as stated in this video link. Do this in order to determine your reward, your risk, and reward to risk ratio after you've drawn a quality zone and have identified a stop loss, an entry, and a target. Hope to see you in the next video.